Good afternoon, dear friends. Two things in our lives are guaranteed. The first is death, and the question is when and who it will catch. The second is paying taxes. Today we're going to talk about taxes. What changes will there be in 2025? So let's not waste any time and dive into all the tax changes for 2025. What topics are we going to discuss in this video today? We're going to talk about changes in the tax-free savings account, RRSP, first-time homebuyers savings account, the Canadian pension system, unemployment insurance, tax brackets, federal tax rates, and we'll also discuss changes that will affect a lot of people, which are the changes in capital gains. So let's not delay and discuss this topic, and make sure to watch this video until the end so you know what to expect in 2025. First of all, let's talk about the tax-free savings account. I think it's the perfect option for anyone if you have money and the opportunity to save and invest it better than in a tax-free savings account. It's just not possible. The limit for this year is $7,000. Unfortunately, our government didn't change the limit this year. I would have been happy if they had changed it, like they did in previous years when they added about $500 each year. But this year it remains unchanged, so you can invest $7,000. If you've been living in Canada since 2009 and have never invested in tax-free savings account, then you have a limit of $100,000. That's a huge amount of money. And if you have any investments outside of the tax-free savings account, that's a big mistake. Because the investments in this account has no downsides, only benefits. You can invest wherever you want in this tax-free savings account. Stocks, bonds, mutual funds, any options, everything is possible. And this option is also available for people who do not have permanent resident status. If you're on a work permit, you also have the right to invest in a tax-free savings account. Investing in a tax-free savings account does not save you taxes, but the growth in that tax-free savings account shell is tax-free. So, if you invest money in a tax-free savings account, and let's say you eventually invested $100,000 and it grew to $1 million, you can take out the entire amount without paying taxes. Therefore, when you invest money there, it doesn't save you taxes, but you can withdraw it anytime with the gains without having to pay tax. That's a huge advantage of the tax-free savings account. So, when you invest money there, it doesn't save you taxes, but you can take it out anytime with the gains without having to pay tax. That's a huge plus of the tax-free savings account accounts. Now let's talk about the RRSP. The Registered Retirement Savings Account. This money is actually meant for when you retire. You have the right to contribute 18% of your income each year. If you're an employee, it's based on your gross income. If you're self-employed, it's based on your net income. The amount has changed, and last year the maximum amount was either 18% of your income or a maximum of $31,560. This amount increased this year by $300 to $490. You have until February 29th to invest in your RRSP. For example, with a tax-free savings account, you can invest anytime starting from the beginning of next year, but when it comes to the RRSP, you have a deadline until February 29th. So, if you're planning to do this, you need to make sure to do it before that date. Just for example, if you earn $100,000 in gross income, if you're an employee, or if you're self-employed with net income, or if it's high density, and if you invest at 18%, you'll contribute $18,000 to that retirement fund and you'll save $6,122. If you don't do this, you'll just be giving that money to the government. So I think RRSP is a good option, especially when you have a high income. If your income is low, there's not much point in investing in an RRSP. But if you have a high income, you can save money on that, especially if you're self-employed. One year you have a good income and the next year it's a bad income. You can always manage this thanks to the RRSPs. You can contribute in 1 year when you have a high income and then in a year when you might have a bad year. You can take that money out. The whole point of the RRSP is that you don't take that money out until the end of the year. But if you're self-employed or if you've lost your job and you have a low income 1 year, you can always access that money before you retire. But if this fund isn't yours and belongs to your employer, then there are definitely some restrictions. But if we're talking about your personal RRSP, you have access to it at any time. And you can do some good tax planning with an RRSP. I often hear people say that a tax-free savings account is better or that an RRSP is better. There's no straightforward answer to that. It all depends on your situation. So, when we work with clients, We advise them on when it makes sense to invest in a tax-free savings account and when to go for an RRSP. Another interesting change in the RRSP is that if you're buying your first home and you're considered a first-time home buyer, meaning you haven't owned a home in the past 5 years. Let's say you might have owned a home, sold it, lived in an apartment, and then you're buying again. You would still be considered a first-time home buyer. But if you're buying your first home, that definitely affects you. In 2024, the limit was $35,000. The maximum amount you were allowed to take from your RRSP to use as a down payment for buying a house was $35,000. In 2025, this situation will change. You can now contribute $60,000. You can take out a lot more money from your RRSP and use it as a down payment. If it's a couple, if you're husband and wife, then you can use every $60,000 from your RRSP. After all, you can put down $120,000 as a down payment to buy a house. That's a really, really significant amount. And if you have the money, I definitely recommend using it. The second plus point or the second good change that has now happened. Before, if you took money from your RRSP to your house and use it as a down payment, you were required to start paying that money back after the second year. And you had to pay back 1/15 over 15 years. Now the situation has changed. You have the right not to pay back that money, not just in the first 2 years, but for up to 5 years. And you had to return 1/15 within 15 years. Now the situation has changed. You have the right not to pay back that money, not just in the first 2 years, but for up to 5 years. This will make it a little easier for you the first time when buying or after buying, because you have to pay the mortgage, interest, and principal, and at the same time pay your down payment, as if returning the down payment to the RRSP. Now you get 5 years instead of 2. And now let's talk about the first home savings account. This is the perfect option for those people who haven't bought homes in Canada and will someday be first home buyers. I believe that a person who doesn't take advantage of this option, but has the opportunity to do so, is really punishing themselves. The beauty of the first home savings account is that it's a combination of an RRSP and a tax-free savings account. If we kind of take the cream off the top from the tax-free savings account and the RRSP and combine the 2 plus points from both options while ignoring the negative sides of these options, then you get the first home savings account. Tax-free savings account. You deposit money, you don't save on taxes, but someday when you withdraw it, you won't pay tax. With an RRSP, you contribute to the RRSP, save on taxes. And the growth in both options isn't taxed. But someday, when you take the money out, it will be taxed based on your income and your marginal tax rate. The first home savings account adds 2 plus points, but removes the negative points. With the first home savings account, you automatically have the right to deduct contributions from your income and save on taxes. When you take that money out, it won't be taxed. The growth of the money in the first home savings account is also not taxed. To open this account, you need to be at least 18 years old. You can also not have status in Canada, I mean permanent resident status. You can have a work permit and still open this account. I recommend everyone to do this, even if you don't plan on buying a house anytime soon. Even if you don't have any money, the thing is that if you open an account, you already have a limit. If you haven't opened the account yet, those years will just slip away. If it's before the new year, go to your bank and open this account to start the timer in your favor. If you're watching this after the new year, you're already late. But if it's before the new year, I really recommend you go to your bank and open this account so that at least the timer starts ticking for you, because this time will work in your favor. The maximum amount you can contribute is $8,000. If you had opened this account in 2023, you could have contributed $8,000 for 2023, as well as for 2024 and 2025. If you're opening this account only now, then you can contribute for 2024 and 2025. The maximum amount you can contribute is $40,000. Whether you're contributing a small amount or a large amount, the maximum is $40,000. If you're a couple, husband and wife, then each of you can contribute up to $40,000, which means you can contribute a total of $80,000. That's a huge plus point of this program. If for some reason you end up not buying that house, you have one perfect option. You can convert that amount or limit into your RRSP limit. And if, for example, you maximize all your contributions to your RRSP and you can't contribute anymore because you're using the maximum amount every year, you can transfer that money, whether it's $40,000, $80,000, or whatever your allowed limit is, to your RRSP, and that will be on top of your allowed limit. And the allowed limit that you had, so there's really no downside to not opening this account. That's why I highly recommend it. Because when you start working and when it comes time for a mortgage, I hope you'll reach out to us because we provide advice not just for investors, but we also make very good choices and give advice regarding mortgages and insurance. When the time comes, we can help you save a significant amount. In addition, we already had clients who took out a mortgage. They did not have this account. We quickly opened this account, deposited money into it, and then we withdrew that money to use it as a down payment. This way, the person automatically got a certain amount that they could deduct from their income for the previous year. So, I really recommend you open this account. Don't wait, and it's better to do it today than tomorrow. The Canadian pension system, we will all eventually reach an age where we will have to rely on the Canadian pension. I really advise you not to rely on it too much. It's kind of guaranteed, but the amounts will be small. There are also additional income sources in the pension bonus, like tax security and the guaranteed income supplement. I'm not going to talk about this topic today. I have a video on this topic, you can check it out. But if we're talking about CPP, there are changes again this year, just like every year. First of all, the contribution to CPP will now be based on a maximum amount of $71,300. Income over $68,500 stopped CPP contributions last year. In 2025, it's $71,300, more CPP taxes, but a better pension. In 2025, this limit was raised to $71,300. On the one hand, yes, it is negative. You will now pay taxes from the Canadian Pension Fund, a larger amount. But on the other hand, thanks to this, of course, you will have a better pension. But let me say it again. I advise that if we are talking about retirement, we should still take care and make other investments. There is no better investment than real estate, so I advise you to work with us. We will help you buy your first home, second, third, fourth, and fifth. I've recorded a lot of videos on this topic, so I recommend checking out my YouTube channel, Invest Solutions. The amount you are required to contribute to the Canadian Pension Plan is 5.95%. If you're an employee, if you have your own business, you have to pay twice as much, because there's no employer covering the other half. In my situation, when I pay my employees who are not on commission but receive wages, I pay 5.95 and they pay 5.95. The maximum amount you will contribute to the Canadian Pension Plan if you're an employee is $4,034. If you're self-employed and have your own business, unfortunately, you'll have to pay the full amount. You'll need to pay $8,068 for the year 2025. 2025, pay $8,068. Our Canadian government has made additional changes regarding the Canadian pension system. We now have CPP 2.0. What does that mean? For people who earn more than $71,300 but less than $81,200, they will pay an additional tax into the Canadian pension system. That's 4% of that income. The amount you will have to pay if, let's say, your income exceeds $81,200 is that after this amount, even if you earn $100,000 or $200,000 or $300,000, you won't be paying into the Canadian pension plan anymore because you've already paid the maximum amount. The maximum amount in this situation for the additional contribution to the Canadian pension system will be $396. If you're an employee, if you're self-employed, then it's $792. The total amount, if we take CPP1 and CPP2 and add them together, is that if you're an employee, you'll pay $4,430 in 2025, and if you have your own business, you'll pay $8,836. If you have your own business, you'll pay $8,836. Now let's talk about taxes, the so-called tax brackets. Depending on our income, there's a certain amount we have to pay as taxes. Up to $16,000 this year, you won't have to pay any tax. That amount has changed too. You won't have to pay any tax on the first $16,000 this year. That amount has also changed. Last year it was lower, not by much, but it was still lower. If you earn up to $16,000 a year, that's especially good for students and people who work part-time because you won't have any taxes from the government. If your income exceeds $16,000 and goes up to $57,000 a year, then you'll pay 15% of your income to the government, from $57,000 to $114,000. The second bracket is 20.5% you'll be paying. The third bracket is from $114,000 to $177,000 at 26%. $77,000 at 26%. The fourth bracket is from $177,000 to $253,000, and that will be 29%. And if you're doing so well and have such a good income that you exceed $253,000, then you'll pay 33% to our government. Don't forget, this is only about federal taxes. In addition to paying federal tax, you also have to pay provincial tax. It depends on your province, so I recommend checking this out. Maybe look online to see how much additional provincial tax you'll have to pay in relation to the federal tax. Here, I would like to make one very important note. I have a lot of clients who have businesses, and their businesses are doing quite well. They have a cooperative. If you have a cooperative and you have a large amount in your cooperative, you know very well that for every dollar you take out, you'll have to pay tax on it. People who have their own businesses have good intentions, and they need to pay for things in life, whether it's to buy something or to buy something else. If you find yourself in a situation where you have a cooperative and you have quite a bit of money there, but if you want to take out, say, $100,000, maybe $200,000, or even $300,000 a year, that will definitely lead to huge taxation. There are some really interesting options, and we often do this right now, where we, thanks to a very interesting trick, it's legal, I've never done anything illegal, it's allowed by Revenue Canada, can help you take money out of your cooperative and pay less tax. So I recommend that if you're in a situation where you have a high income and you'd like to pull more from your cooperative without paying a lot in taxes, reach out to us and we'll help you with that. If you have your own business and someday you decide to sell it, you currently have the opportunity to use the lifetime capital gain exemption. The amount has increased by $1,250,000. If you decide to sell your business for up to $1,250,000, you have the right to sell it without having to pay taxes. Of course, if you decide to sell for $3 million or $4 million, you will have to pay taxes on this difference. But on $1,250,000, you will not have to do this. There are some really interesting tax options where you can use something like a family trust, and if your business is worth $10 million, you can sell it and use $1,250,000 for yourself, your kids, or your spouse. But that's a different topic. It's just important for me that you know this amount has increased this year. The second piece of good news is regarding unemployment insurance contributions. To be honest, it's just a small amount, but at least something is going down. The amount you will have to pay for unemployment insurance is $65,700. That's in 2025. In 2023, the maximum amount you had to pay for these contributions was $63,200. In percentage terms, you need to pay 1.64%. In 2024, it was 1.66%. Second, medical expense threshold. This is also an interesting point, especially when I often see people who have their own business and are only using this program. This amount has now increased by $2,233. Last year, it was $2,759. But if you have your own business, there's an option where you can pay all your medical expenses through your corporation or your business. That's a huge difference because right now, if you go to the doctor or something like that and you don't have any benefits, you have to pay after you've already paid your taxes. If we're talking about this program that I recommend, which we can help you, you can pay all your expenses with money from your corporation or your business. This means you're paying on gross income, not net income. This will save you a significant amount on taxes. The next option is child benefits. The amount has increased this year. It's now going to be $7,187 a year for children under 6 years old, and for kids aged 6 to 18, they'll get $6,570. This amount will of course change depending on what your income is. If a new government comes to power, they plan to change this, but today, the more you earn, you know very well, the less you will have. Unfortunately, our government makes, I think, the wrong decisions. But they need to find a way to get money. If you looked at what our budget looks like, after our finance minister resigned, maybe she even resigned because she was afraid to present that budget. In any case, we have a huge deficit. Our national debt is enormous. They need to find a way to get money. I don't think this will save them much, but they're trying. And what did they do? If you have your own home where you live, you don't have to be afraid. No extra tax if you sell for more. Personal properties with gains up to $250,000 aren't taxed more. But if you have extra properties under your name, each building with a gain up to $250,000 avoids increased tax. For instance, buying a house for $300,000 and selling for $400,000 under your name means no worry. Each house or apartment under your name is taxed at the old rate. For example, if you bought a house for $300,000 and sold it for $400,000 and rental property was under your personal name, you don't need to worry, because up to $250,000 in gains on each of those houses or apartments or whatever you have, if they're under your personal name, they are still taxed at the old rate. This means that 50% of your gain is not taxed, while the other 50% is taxed based on your income. However, if you have a corporation and your properties are under the corporation's name, unfortunately, that $250,000 exemption doesn't apply to you. This means that 50% of your winnings are tax-free. The other 50% is taxable depending on your income. If you have a corporation and your properties are under the corporation's name, unfortunately, that $250,000 exemption doesn't apply to you. Every dollar you earned, let's say you bought it for $300,000 and sold it for $400,000, you have a $100,000 gain. Unfortunately, you're already subject to the new rules, and the new rule is 50% capital gain, but 67%. This is definitely bad news for people who have investment properties that are held in a corporation. Cooperatives, if there used to be some advantages, I now think there are no significant benefits to having these buildings under a corporation. The only thing related to the down payment might be a bit easier there. But from the tax perspective, of course, these people are facing negative changes. This has also affected a lot of professional fields, like doctors and so on, because they all operate under a corporation. They don't have pensions, CPP, they all invest in the corporation. And now, of course, this change will have a very negative impact on them. They don't have pensions, CPP, they all invest in the corporation. And now, of course, this change will have a very negative impact on them. We already have too few doctors, and now the last ones will run away. But unfortunately, our government has already made a name for itself by making one mistake after another. I think this is one of the simple mistakes that they made, and hopefully they won't make in the future, because we will replace them. And I also hope that if we get a new government, things might change back to where capital gains will be 50%, like it was until today. If you have any questions or need mortgages, insurance, or investments, give us a call. We'd be happy to help you. We work all across the country. We have no restrictions, and we're happy to work wherever you are and whatever financial topic you're interested in. That's all for now. I wish you all good spirits, God's blessings and health. Until next time in the virtual world, this was Victor Schäfer. Thank you for watching this video. We hope you found it helpful. We'd be happy if you share it with your friends and acquaintances. Follow us on Facebook at VS Financial Group and on YouTube at VS Solutions. If you're interested in getting a mortgage or need insurance, fill out the form on our website vsolutions.ca. Contact us at 1-800-77282-0904 or write to us at safe@vsolutions.ca. Enjoy life today and we'll create a successful tomorrow for you. Or write to us at save@www.vsolutions.se. Enjoy life today and we'll create a successful tomorrow for you. Dr.